Hello, everyone. Here is Trevor Scelso, one of the general partners of the fund. We are looking forward to this recording because it's going to give us a nice breakdown of our overall investment thesis, and specifically excited to get into what recession-resistant means to us and the fund, and specifically how we're going to operate within those markets. So, Trevor, why don't we go ahead and dive in there? What does recession-resistant mean to you?
Yeah, great question. So generally speaking, recession resistance means that if a recession occurs, your assets, your cash flows are less affected than you would expect to see nationally or in highly volatile locales, right? And that's still pretty broad. So let's get a little granular. So when you're thinking of short-term rentals in general, you really have almost like two components or two businesses, if you will. You have the underlying asset that is real estate. And then you have the business that is hospitality. And depending on your goals, you have different concerns about each one. But just exploring first the real estate one and considering how price behaves over time and during different economic cycles, what I've found is, in fact, let me go ahead and share something with you here. Pull it up onto the screen. So what we have here is a graph of home prices over time, okay? And you may notice something right around this general area, if you can see my mouse moving around, or the cursor, and that's the bubble, right? That's the real estate boom and bust that we experienced in early 2000s, okay? And we're looking at it three different ways here, all right? So this is index pricing for the nation. All right, the home price index developed by the Federal Housing Finance Administration. All right, and so they track home prices nationally and locally. And so this blue line is national home prices. All right, how they behaved. So we can see the run up to 2006. Okay, and in fact, this starts in 2001. All right, so we can see the run up to 2006, the bubble right around here, okay? And you can see where prices started to decline following Q2 2007, right? They went down, prices went down into recession, and then, they recovered, okay? Simple enough. Now, this gray line represents locales, specifically metro statistical areas that experienced higher than national average growth leading up to 2006. So for the period 2000 to 2006, right around here, all of these locales grew, as you can see visibly, at a much faster pace than the national average. This orange line are the locales that grew at a slower than average pace compared to the nation leading up to 2006. And there's some really incredible insights I think you can glean here. Number one, these faster growing locales. Think coastal California, Las Vegas, Phoenix, where you heard about all the problems, right? They experienced more or less upward price spirals followed by a really hefty collapse in prices. And prices started collapsing early 2007, right? Which is sooner than anywhere else, right? The national average, you really didn't see that hard downward trend until later into 2007. And for these slower growing locales, they continued upward price movements till right around here. So we're talking early 2008 to early 2009 before they really started seeing declines in home values. Okay. Also, the distance between here, the height in these local housing economies and the bottom is much more dramatic, as you can also tell, than in both the greater nation on average and these locales. Hold on just a second. All right, where was I?
So it seems like based on this graph and the data that you have been accumulating, we're really focusing on markets that are less volatile when through the lens of the macroeconomic finance sector.
That is definitely something that we're focused on in this fund for a couple reasons. Now, again, this price collapse amounted to 30%. on average over, from 2007 till the recovery began that bottomed out in 2012, right? So that's a, 4 or 5 year period, 30% drop in prices. And here at the height, in these local economies around early 2009 to, this was the bottom right here, early 2011. So just a couple, 2 or 3 years really. And that's only a 7% drop on average. So yes, prices went down, but not near as dramatically. And it started later and started recovering sooner. So when you're looking at hold times of 5 to 7 years, which is really what we're looking at, you don't want all that volatility. You want a more predictable exit plan. Okay, so for the purposes of this fund, yes, we intend to exit it in a 5 to 7 year period. We want to sell it to a large institution, ideally. And large institutions like bonds, they don't like volatile, risky assets. So that's definitely our target for the fund, is these types of locales represented by this orange line. Now, that said, if I was thinking of a really long-term hold, like forever or decades, I wouldn't be afraid to get into this category of locales at all, because just like the stock market, the more volatile stuff plays out better from a return perspective over the really long term, right? Like a small cap growth fund is probably going to perform better over a 30-year period than the S&P 500, for example. So depending on your investment objectives and goals can help guide your decision in where you want to invest in. But I think this is really useful knowledge when considering we want to invest in recession-resistant markets that are stable over the long term. Maybe not as sexy of returns, but hyper stable over all types of economic cycles.
So, what are some of the aspects of these locales that represent this orange line? Are they economically diverse? Do they have a growing population? What are some of the things that you're looking at?
It's interesting what actually causes such stability in their housing prices. And I don't think it's identical for all locales. When you start getting into the weeds on individual places, you find a mix of things. It could just be a locale that has a local oil economy, for example, which is a totally different economy than the national economy, right? People still gotta drive places, so we still need oil. So like in North Dakota, there's a lot of stable housing economies. Those are constantly drilling for oil, and no matter what's going on nationally, they have a housing need. There's places in Texas that don't have zoning laws, which creates a much freer market. It allows demand to contract, or rather supply to contract with the needs of demand, so to speak. And so it creates this really stable pricing outcome, real estate pricing outcome, because there's so much less regulatory burdens. There's no zoning in certain parts of like Texas, for example. So it could be, regulatory factors. It could be local economic factors. Nonetheless, it's happening. And what's, another kind of important thing to note is if we look at this recovery here, we're kind of like the nation itself more or less returned to mean. And these slower moving economies, like the nation kind of like on average went back down to their level. And then as the recovery began and we went into, the pandemic situation right around here, you again see the separation, right? Where the national housing economy is growing faster than these very same locales that were stable before the most recent recession. So they behaved that way consistently over a period of decades through all kinds of different economic situations, including and even in the pandemic, right? If we look at, we all know what happened, right? Prices started to go down in Q3 in 2022. Look at the drop in these volatile locations. It's less significant, or it's more significant than the drop nationally. And in these same locales, they flatlined. They didn't go down, they paused, and now they're back on the upward tick. All right. So we're seeing this consistent behavior in these housing economies, regardless of what the reason is locally. It's consistently happening over all types of economic cycles.
Mm-hmm. So it's obviously better to have less volatility when we're looking at individual assets from a market perspective as well. But why is it so important for us to look at this risk-adjusted volatility and how it affects asset prices through the lens of short-term rentals?
Yeah, again, the main thing is it depends on your goals and objectives as an investor. So as a short-term rental investor, again, I'm okay personally investing in these locales if I'm going to hold on to the asset forever. All right. However, with a short investment horizon, I would be looking in these locales. Now, for short-term rentals in particular, we kind of have to get in now to the hospitality sector as well, because there's certainly some implications there. All right. And I'll go ahead and just pull up another graph. I love graphs. Now, hospitality sectors, as you might expect, perform the same way. All right. So what we have here, this is just a small subset, okay, of different places that I kind of picked out randomly just earlier this week, incidentally. So if we look at the nation, we've got three lines here. We've got pre-recession, which is the blue line, 2001 to 2007. For the hospitality, its economy and its recession occurred after the housing recession, right? If we recall, housing collapsed and then the economy followed. Okay, so we kind of pushed the timeline just a year ahead. We went from 2000 to 2006. Now we're looking 2001 to 2007 in hospitality. And in the greater U.S. during that time, the average year-over-year growth was 5%. During the recession, 2008 to 2011, the growth slowed substantially, right? On average, 2%. Okay, and then the recovery, 2012 to 2019, leaving out the pandemic anomaly, growth accelerated substantially. Year-over-year average was 6%. Okay, now if we look at places like Nevada or Clark County, where Las Vegas resides, their average year-over-year growth during the recession was negative, right? Here's the zero line, it's below zero. The number isn't populating, but it's somewhere between -1% and 2%. All right, and then the pre-recession growth was really high, over 6%, well above the national average and well below the national average during the recession. And then the post-recovery, right, the post-recession recovery was, again, I mean, it's among the highest on this chart. So Las Vegas's hospitality economy is incredibly volatile. It is super sensitive to recessions. And when I say hospitality economy, I'm talking about hotels, motels, bars, restaurants. This is how the Bureau of Economic Analysis measures the hospitality GDP. That's what I'm measuring here. That's where the data is coming from. And we can see that Las Vegas is super susceptible. So as a short-term rental investor, this could also be cause for concern. While as a real estate investor in particular, thinking of a long-term hold, I may be okay with a volatile housing economy because in 20, 30 years, a house is going to be worth more than if I invest in any other local economy. But if during that time frame, I'm going to experience really volatile cash flows as well, not just asset appreciation change, I might want to think twice about working there, right? Or investing there as a short-term rental. So that's something important to consider. Look at this, right? We've got Wisconsin. This is the whole state of Wisconsin, okay? 2% growth on average during the recession, 2008 to 2011. 4% growth on average pre-recession, and 6% growth on average post-recession. So all three of these points are much closer together than most places here, with the exception of the state of New York, incidentally, which experienced pretty much the same growth during and before the recession, and then experienced a very similar post-recession growth as the rest of the national economy did. But just some kind of insights to glean. We're also, for the fund's purposes, keenly interested in stable cash flow economies. Now, they don't always match up with stable housing economies, so what we're really looking for is the intersect of both, where the housing economy is stable and the hospitality economy is stable.
So what are some of the ways that you're pairing up those two to find the markets? It is simple as, running some VLOOKUPs, or is there some proprietary stuff that you're assessing?
It's not so much proprietary as you got to have the know-how to do it, because most of the data out there, especially for this macro level stuff, is broadly available. You just got to know how to get it, download it, and manipulate it. And so in that regard, it's just a matter of more spreadsheets. You always need another spreadsheet, right? That kind of pairs them together, looks over the entire country, tens of thousands of rows of data, and just filtering out, all right, which ones meet both of these characteristics, right? And to what extent do they meet it? Because there's degrees of variation, right? And then, kind of picking from there which ones seem the most appealing from a macro perspective. We still got to dive into short-term rental specific too, because maybe an economy is great in both of these things, but prices are really high and short-term rents are really low. So you're going to have stable, low cash flows forever, or maybe negative, right? Because the cash flow is enough to cover the debt service. And so then we got to dive a little bit deeper into the actual short-term rental economies in these places. And then kind of dive into what are the prices to revenue. So I'll give you an example. All right. Here's what's going on in the short-term rental market as of late. Now, this data is just a couple months old, but this graph I'm looking at here, or rather this is a local one. Let me go ahead and pull up a national one for you. So nationally, year-over-year growth as of May in the supply of 1 to 3 bedroom homes is 22% nationally. 22% of all the homes on the market that are 1 to 3 bedrooms in size are new entrants within the last year. Okay. The demand to stay at a 1 to 3 bedroom home has grown 15% year over year. So we have supply outpacing demand in the most easy to buy sector of housing, right? Like 3-bed, 2-baths is the most predominant thing out there. So the prices are the most achievable for most people, most would-be investors. First-time short-term rental investors are buying these things up, okay? And what we have here, this gray bar is just the difference between demand and supply, all right? We can see it's positive, so demand is positively higher than, or supply is positively higher than demand by 7%, okay? And revenue year over year has declined 4%. For these homeowners, you've probably heard the headlines like Airbnb revenues are down 40%, yada yada, this and that. All right,
headlines are amazing.
It's this sector of short-term rentals in particular. Now, if we look at 4 bedrooms, the supply nationally is still outpacing demand, but it's by 4% instead of 7%, and revenues are in fact still up 3% year over year. If we go to 5-bedroom homes, revenue is up 5% year over year for 5-bedroom homes, 5+ bedroom homes. And the supply and demand gap is only 3%, the growth of supply versus demand.
Yeah.
And then if we go to 5-bedroom homes with a pool and a gym, think really, really large, well-amenitized homes. Okay. This is where the most opportunity is. Revenue has grown 11% year over year for these really large, well-amenitized homes. All right. And the demand and supply gap is virtually non-existent, 1%. Okay. So moving to a local market, because all real estate is local, right? At the end of the day, national trends kind of give us something to consider. But then you got to look locally. And so here is an example metro, College Station, Texas, we'll call it. You can steal that from me if you want, but I've got a lot more up my sleeve too. And, here, 1 to 3 bedroom homes, again, we got the same supply and demand gap. It's actually larger, 13% greater growth in supply than demand. However, revenue is still up. This is the effect of the stable economy situation, right? Real stable tourism economy in College Station, believe it or not. For a handful of reasons, number one being Texas A&M being there. A football stadium larger than most NFL stadiums and always packed to capacity, right? As soon as we get to 4-bedroom homes here, the gap between supply and demand is non-existent. It's the same, 36% growth in supply, 36% growth in demand, positive revenue growth. And then once you get to those larger homes, demand is actually outpacing supply. There's not enough of them there to keep up with the growing demand. And same thing with the more well-amenitized larger homes. Okay, so diving into, so we find these locales that have macro recession-resistant parameters, right? And then we're looking at where is the opportunity specifically in short-term rents? Where is demand not being met? And we're consistently finding it in just the larger, more well-amenitized homes. There's natural barriers to entry in that there's not a lot of 5-bedroom homes on the market. There's a 3-bed, 2-bath on every corner, almost literally.
Oh, yeah.
Right. But a 5-bedroom plus home is hard to come by. They're also harder to afford. Mm-hmm. So there's these really nice barriers to entry that stand to keep this dynamic of demand outpacing supply potentially going for a while.
Yeah, especially when you think about the millennial generation. No one is really looking to purchase these size of homes for their families anymore. They don't want to take care of the pool. They don't want 6 bedrooms. It just doesn't make sense. But that same demographic, maybe they're dinks or they earn a lot of income, but they still want to go on vacations and they don't want to go into a hotel. They would rather get one of these properties and plug 3 families in there, do pizza nights, have an arcade room, go to the pool, hit up some mountain biking.
Exactly.
And that is the demographic that these assets are going after.
Absolutely. And so now from here, it's just a matter of, okay, so we can identify all these markets that have macro positive factors, and then opportunity is spotted. But now it's just a question of like, okay, but what does it cost to get one of these homes, and what kind of revenue can we expect? All right. And I don't have a spreadsheet to show you. I do have spreadsheets on that. They're a lot more. It's mostly just numbers, not like nice, pretty graphs like this. But long story short, we do have a data approach to isolating those types of opportunities, the return opportunities, if you will, where we're looking at Zillow's median prices, which they're putting out every month, and we have subscriptions through data brokers that tell us what type of revenues are going on by zip code in short-term rents, and we're just looking at like, okay, what are the average rents, what are the average short-term rents, what are the median prices, and where are we seeing the biggest ratio there of like if it's 100K average revenue potential a year, and median prices are 300K, right? So that's revenue is 30% of prices, right? So the higher that number is, the more interested I am in that locale. And so then just diving in from there and going further and further down the rabbit hole of analysis. But that's the general approach that's guiding our investments into short-term rentals, is kind of getting to that point of identifying the best return opportunities, and then really diving into the market and getting to know its nuances, and seeing what's out there that can accommodate what we're looking for, these larger, well-amenitized homes.
Mm-hmm. Yeah, it's a great breakdown all the way from the macro, looking at each market, figuring out which locales have been less volatile, historically speaking, especially in the Great Recession, pairing those markets up with the hospitality sector as hard data, because essentially these short-term rentals are operating as a hospitality investment. And those are the 2 most important things. And then exactly what you said, looking at that revenue to purchase price is very important. Obviously, price is the largest driver. Revenue is the largest driver in these houses, in these assets. So if we can stabilize the expense ratios through excellent property management and the various other things that we're doing, you can really drive that NOI growth, which in the long game, consistent NOI growth year over year is what will really make this fund incredibly profitable at the sale. So I'm not sure
exactly,
and that's the ultimate end goal. Selling this to possibly an insurance company as a portfolio sale that's actually trading at a cap rate, whereas historically, since these are single family residences, they can be driven by the local demand, whereas families are looking to purchase this as a single family house, because it's kind of similar to what we experienced in self-storage many years ago when it was just a baby industry. But now it is a very mature market. There's special loan products out there for it. There's big players. There's REITs for it. We anticipate in 5 to 10 years, their short-term rental space will mature to that level. And once it does that, assets will trade at a cap rate. They won't be traded at consumer preferences on if they like the pool, if they like the granite countertop, if their grandma is 2 blocks away. Like, none of that will be at play.
It won't be relevant. Yeah. And that's exactly it, because you got the 2 different pricing approaches to single family real estate, right? You got the sales comparison approach, which is what dominates the single family market, for sales, right? You got to have an appraiser come in because you're getting a conventional loan, and they're going to see like, well, what are the closest comparable homes to this, and what do they sell for? And then they extrapolate a price for the property that you're purchasing based on that. It's kind of an antiquated system and honestly not that great, but we're stuck with it for now, right? And then, the way that multifamily is evaluated is simply like, what is the return?
Yep.
Am I getting a 9% return, a 4% return, a 12% return, right? And the lower the return you're getting, the higher the price. So, generally speaking, these types of portfolio assets, if you will, or true real estate, commercial real estate assets, I think right now they're trading at around a 4 cap. It's actually getting hard to find stuff that makes sense. But, over time, it's somewhere between like 4 cap and 7 cap, right? 8 cap, maybe 9. Yeah. People are buying multifamily.
Well, just to clarify, the cap rate and the price have an inverse relationship. So the higher the cap rate, the lower the purchase price. So, yeah.
Exactly. So, that's what it's like. People are having a tough time finding stuff above a 4% cap rate, which means you're paying a lot and getting a very little return. Mm-hmm. You're getting a 4% return.
Well, right? Especially when you're
getting
a
9% return
as well. Like just covering your debt service is wild right now.
I mean, you need at least like an 8 cap, 9 cap to cover your debt service these days. And so what does that look like if we sell this whole portfolio at a cap rate as opposed to the sales comparison or just the appreciation rate of the price we buy it at, right? And so that's what we've been spending a lot of time on lately, and I could actually run you through that if you like.
Let's do it.
All right, let me reshare. So we've built out now this is a pro forma. We're happy with it. I think it sets really good expectations about what we're trying to do. But be advised, we are trying to predict the future here. So we're saying 5 to 7 years exit. Maybe it takes 10, maybe it happens in 3. But this is the vision, nonetheless, that we're driving towards with this fund. And so there's a lot of expectations on here, or a lot of assumptions. But this is a 40 property portfolio, right? So our fund is focused on bringing in $10 million in equity and cash and buying short-term rentals with a mix of financing arrangements from more or less traditional to more creative, subject to, stuff like that. We do see some opportunity with all those low interest rates out there, and people need to get out of their home for whatever reason. We're going to exploit that. And then, just cash, right? Especially for value add stuff where we can only do one refinance transaction and not do a purchase transaction with a mortgage, right? And save on costs. So that's kind of the mix of strategy there. So-called rent-ready homes, which are probably on the MLS, probably going to take on a 9% interest rate to buy those. Buy, renovate, rehab, repeat process, or we pick up an asset cash that's cheap, renovate it, and then refinance money out to go take down more assets. We can usually get a lower rate on those because we are going to take a lower loan to value, and at the same time we can finance some points to drive down the rate into those types of loans. Mm-hmm. And then we've got subject to / creative financing, which we're anticipating on average 4%, at least in this pro forma, which is a little conservative. We could probably drive that down to on average 3% for those types of acquisitions, which are just popping up more and more every day. I'm getting them in my inbox all the time. Sub 2 deal, right? People need to leave their house for whatever reason.
Yeah, they're underwater.
Now, exactly. And now as far as capital expenditures go, for these rent-ready homes on the MLS, it shouldn't be much more than 5% of the purchase price of the home. For the ones that need renovation, we're looking at 25% of the purchase price of the home on average. Not trying to go down to the studs too much. Paint, floors, countertops, cabinets, call it good. Make it look modern, call it good. And then sub 2 is similar to the rent-ready stuff, right? Probably about a 5% CapEx. And then you've got your staging and decor at about 10% of purchase price across the board. That's our expectation of just kind of the acquisition situation. All right. And then we've got some loan to value assumptions based on just what's available in the lending market today. The time frame is going to take us to buy this portfolio, the time frame it takes us to stabilize each asset class. Again, this is all like the upfront acquisition period of everything, just to kind of give you a broad picture of what it's all looking like, what our assumptions are. Now, for the goal of selling to an institution, ultimately what matters is almost none of what I just mentioned. What matters is the net operating income. And so to that, there's two components. There's the revenue and then there's the cost, the OPEX. Okay. So we've gotten really good my team with me and my management company, and then there's other general partners in the fund that have a long history of taking down short-term rentals, right? And what I look for, I'm not going to touch a short-term rental if I don't see a good chance to meet or exceed 20% of the purchase price in terms of revenue, right? So if a house cost $400,000 to purchase, I need to see a very clear path to make $100,000 in gross revenue. All right. And if you can consistently do that, you're consistently having money makers. It's going to cover the debt service in pretty much every situation, unless interest rates go to 20, it's going to cover it. Okay. If you can hit 25%, you have a cash cow. And I have several of those, in fact, under my belt, both that I've helped people acquire and that I've acquired myself personally. So it's out there. It's out there to this day. Okay. A little bit higher revenue assumption for value add deals because we're adding value, right? In fact, all the value we add is going to be focused on driving revenue rather than driving a higher after renovation value. And that's an important distinction between our approach to renovation and the approach of like someone who flips homes. They want to get the highest after renovation value. We would love to have all the value we add in terms of cash also be at least a 1-for-1 ratio. If we put $100K in, we'd like to see that home at least appreciate in value by $100K. But even if it came in a little lower, but it really drives up our revenue.
Yeah.
Because what do people want when they go on vacation? They want heated pools.
Yep.
Guess what? Heated pools don't really add a lot of value to the home. They add about as much value as you spend on it. Mm-hmm. Maybe. Not always, less. Right? Probably, in a lot of cases, less, especially when you put on all these fancy pool heating systems that we like to do, that I like to do when I buy a short-term rental, right? It's negligible to the home value nearly, but it skyrockets your revenue. And again, we want NOI, we want net operating income, right? The second component of that is your operational expense. If you can keep your now, in general, operational expense for short-term rentals is about 50%, what I've seen. And I've looked at dozens of cases on that. And the larger the home, the lower it is, incidentally, because you get economies of scales. And I'll give you a real quick example. To clean a 3-bed, 2-bath home that's 1,500 square feet could cost you $200. All right. To clean a 6-bed, 4-bath home that's 3,000 square feet, it's literally twice as big in every respect, probably going to cost you $400. It's going to cost you twice as much. But the revenue, again, we just looked at some, differences between revenue growth in larger homes and smaller homes, right? The revenue is going to be 3 or 4 times as much. Mm-hmm. So the cost of cleaning as a percentage of revenue is less. Okay, so and that's true among other operational expenses too in these larger, well-amenitized homes. So by targeting those, we can help keep OPEX lower. And at the same time, part of your operational expense is the day-to-day management, which is intensive and necessary. And so we've put together we're putting together a management company that will exclusively serve the fund. Again, I operate a management company. I preside over it. We have another general partner that has been managing short-term rentals for years now. And so we got a pretty good idea of how to put this together and just separate it from both of our businesses and make it something that exclusively serves the fund. And its goal, the way it's measured is not by profit, but by how well it keeps operating expense at or below 45%. And it will be compensated based on that. In fact, it'll have its own waterfall structure where the lower OPEX is and the higher revenue is, the more money it makes. So it is held accountable to achieving stable and growing net operating income, mm-hmm. right? We want to make this thing behave like a bond as much as possible so that we can be attractive to these institutional buyers. So that's the general outlook. I know we just went over a lot and we didn't even go over everything, but to give you an idea of what that looks like at exit, okay? Let's sell this at a 9% cap rate, really high cap rate, in 5 years, okay? Our return on investment at the portfolio level is 19.8% and 15.8% for LP investors, for retail investors. Okay, that's pretty good, and that's actually not at a cap rate. I was thinking that's pretty good, but that doesn't seem as high as I thought it was. That's actually just based on an appreciation rate of 5% mm-hmm. over that 5-year period. So sales comparison approach, like we were talking about, does it have the right countertops and where's grandma located?
Yeah.
Right. that's still pretty good there. So that's kind of like our worst case scenario. Like the industry isn't mature enough, but we're at a point where we should exit 15%, right? Now, if we sell this as a portfolio at a 9 cap, right, this puts our fund over 20% return. This puts our LP investors at over 18% internal rate of return. And this is not assuming this is assuming we only average 20% revenue, right, that we just talked about. If we can average 22% revenue here and 21 here, right, and 32 here, now we're going to be well over. Again, net operating income is what matters when you're looking at a cap rate. Now we're pushing over 20%. So and we can, our internal, the way we're holding ourselves, the standard we're holding ourselves to internally is to hit 25%, 35%, 25%. What we're underwriting to, or rather what we're showing our investors in the interest of being conservative and not being, called out as BS, which we could be dead wrong in hitting all those really high numbers. The much more achievable ones, things still look really good, right? Much better return than you can find in the stock market or multifamily in today's environment. So that's what it's looking like there. And then we also have, opportunities for fund managers to come in and get better terms than are offered to retail investors. We have different classes of shares for people that want to bring in investors under their own special purpose vehicle into ours, where the fund managers can make 4% plus annual average on the money they raise for their fund, right? If they set up their fund how they want, their special purpose vehicle. So we got some really good opportunities for SPV operators as well. That can give the same returns to their investors that our retail investors are going to get.
Yeah. Important to note that this is limited to accredited investors only. So just know that going into these discussions with, your partners, investors, etc.
Exactly. So I think that's, I think we, they can call me back. So I think we've kind of covered a lot of what you kind of were looking for up front, right? The general thesis and how it all applies. Like, what do the numbers actually look like for investors? If we implement the business plan, and kind of ranges, like if we don't fully implement it, if we don't achieve these really desirable outcomes that we want, and then also so what's the downside, right? And then what's the upside?
Yeah, exactly. It was a great synopsis. And I guess one thing I just like to call out before we close out is the opportunity to rent these properties at a midterm level. Yes, we are shooting for, the fund is shooting for, short-term rentals, weekends, maybe weeks at a time being rented out. But there is obviously the potential to rent these out for a month or 2 months, depending on what the demand is looking like. Obviously, that is not baked into these assumptions, but the flexibility is there if the investment thesis per asset in that specific locale needs to shift a little bit to the market. So there's a lot of flexibility within these assets.
Yeah, absolutely. I've done some midterm renting. I've marketed some properties, like, in Lake Havasu City, for example. We'll set our properties up so that they're only available for 30-day plus bookings during the so-called snowbird season, because we get a lot of people from Wisconsin down in Lake Havasu in the months November, December, January, February, right? And we've had properties book and not book, right? And so we just short-term rent them if they don't book, and we midterm rent them if that happens. And midterm rentals, they do have what's really nice about them is operationally they're very easy to manage, right? Because you're not constantly doing turnovers. There's not constantly a house full to capacity. It's like a small number of people typically that just want it for an extended period of time to be completely furnished, and you have one cleaning turnover when they depart.
Yep.
And that's it. And there's not a lot of repair and maintenance stuff going on. So yeah, that's absolutely like an option for us that we can use as needed in the fund.
Yeah, absolutely. Well, I think that was everything on my list. Did you have anything else you wanted to cover, Trevor?
No, we've done a lot. I mean, this should lead to about as many questions, new questions arise as we just answered. But I think it's a really good starting off point to kind of understanding our thesis and our business plan.
Yep, I agree. If folks do have more follow-up questions or just comments or concerns, where can they reach you?
They can definitely find me at 20pluscapital.com. That's where they can find me, or my email, trevor@compoundgti.com, my Instagram at Trevor Scelso Actual. There's a couple ways, and I'd imagine that most anyone that watches this may just already have my contact information too. At sometimes, but anyone who doesn't, those are my Instagram's a really good one. Just direct message me there.
Boom. DM him up on the Insta.
That's it.
All right, Trevor. Thanks so much for walking us through this really good investment thesis. I appreciate all the work that you have put into this, and it takes a lot of data analytics and a lot of grind, to say the least, in these spreadsheets to come up with the thesis that you have. So appreciate you putting it all together, and yeah, it's a great opportunity, and look forward to seeing what happens.
Absolutely, man. My pleasure. Thanks for having me.
All right. See you, everyone. See you, Trevor.